Hi, I'm David Stein on Money for the Rest of Us. This is a channel on money, investing in the economy. Today, we're looking at carbon investing, an asset class that has returned over 80% in the past year. What does it even mean to invest in carbon or carbon's emissions or carbon offsets? Is there a way we can participate in it? And what is driving the market? Let's take a look and dive right in. When we talk about carbon, we're really referring to carbon dioxide and other greenhouse gas emissions. Here we look at the share of global CO2 emissions by country, and then compare their share of economic output or GDP. What we see is China has the largest share of CO2 emissions, much larger than their share of GDP, whereas the European Union, which has had CO2 regulations in place for some time, one of the first cap and trade markets to actually invest in carbon, their share of CO2 emissions is much lower than their share of the economy. And the US, India is about the same. If we look at China, the US, and the UK's CO2 emissions, China's are increasing way more than those other two countries. But if we look at China on a per capita basis, while their economy is growing, and so their CO2 emissions are growing, but on a per person basis, they're not growing as fast. But China, like many countries, needs to take steps and are taking steps to reduce their greenhouse gas emissions. If we look at this chart, we see the percent of each country relative to the total emissions. And you can see China is growing while the US and Europe are shrinking. Now, different countries have passed regulations, mandatory reductions, and there's also voluntary carbon emissions reductions. These mandatory reductions are incentivized by governments. They utilize what's known as a cap and trade system, which we'll take a look at here in a minute. There's actually an active futures market for trading these carbon emissions allowances, and you can invest in them. Now, voluntary reductions are completely different. The incentive comes from stakeholders, the investors, the employees, the customers, to ask and demand that private companies take action against climate change to reduce their carbon footprint. And there's different ways to do that to purchase these offsets. But this is a newer market. It's an immature market when we look at the futures, and there, at this point, isn't an ETF available. Now, we're going to take a look at both of these markets. We're going to spend more time on the cap and trade market because that's the one that we can invest in, and that's the one that drove those 80% plus returns in a carbon ETF that I'll share with you. Now, these emission trading systems, governments are the ones that set the cap. They say that certain industries can emit only so much greenhouse gases, and that level is lowered over time. And so companies in those industries have to either reduce their emissions or buy offsets, because some companies are able to reduce their emissions even more than the requirement, and so they're able to sell those emissions allowances. A market for that is the European Union emissions allowance market. And there's a futures market. They're called EUA, and each UA allows you to pollute a certain amount of carbon. There's also the California emissions trading market and the Regional Greenhouse Gas Initiative, which makes up of New England states that have come together to have regulation to cap emissions and then allow for trading in those markets. The supply of these emissions credits, or these EUAs, are set by the government. It's somewhat of an artificial market. The economists call it a supersized OPEC. So it is sort of a managed market where the supply is set, and as countries and regions such as Europe decide that they want to reduce the target even more, add more industries as part of the cap and trade system, they'll provide more of these allowances. They'll release some, they'll give them away, or they'll sell them. But that's what's trading. On the other side of the market, you have the buyers. It's market driven. It's companies wanting to buy these carbon emissions reductions, these offsets, or it's driven by speculators, investors in ETFs. And this is somewhat controversial. Are these speculators driving up the price more than what the market would do? Or are they providing liquidity? Now, here's how these markets work. We don't know what the future price will be, but here is the actual, this is as of September 2021, the cost of carbon emissions on the European trading system, about 60.55 euro for the November contract. If we go out to December 2023, it's 61 euros. Now, in order to make money in a futures contract, when you enter into the contract, let's say we entered into the December 23 contract today, it's at 61 euros. In December 2023, that future, the spot price, needs to be above 61 euros, or you're not going to make money, nor is the ETF that has bought those futures. And one reason ETFs have done so well this year is because that future price has jumped. It's nearly doubled because the European Union said they wanted to include more industries in this cap and trade system, and that has driven up demand, and it's gone up. Now, we don't know what the future price of carbon will be. If you're investing in carbon, though, that's what matters, because that future price has to go up. Here's the ETF that I mentioned. It was launched in July 2020. It's the KraneShares Global Carbon ETF. The ticker is KRBN. Its expense ratio is 0.78%, has about $800 million in assets. It's only invested in these carbon emissions futures. About 75% are in EUAs, 20% in California emissions futures, and the remainder in these regional gas house initiatives. Now, if you add those three numbers up, that actually equals 101%. So they're a little over leveraged right now, but not by much. This ETF has done incredibly well. But in order to continue to do well, the price of carbon has to go up even higher. Now, let's take a look at the voluntary carbon offset market. There's two types. There's avoidance, where we're just not going to release carbon. And this can be done by not cutting down trees that might have been scheduled to be cut down. Or it could be actually removing carbon from the atmosphere. Now, you have all these projects. There's thousands and thousands of different projects. Some of them are certified, some are not. It's sort of a wild west when it comes to the carbon offset market. And again, these are private enterprises that aren't required now to reduce their carbon footprint, but are doing so from pressure from customers and shareholders. The price for these carbon offsets is really low, only about $5, because there's so many projects out there. Now, the hope is that over time, as more and more companies agree to reduce their carbon footprint, and as some of these easy projects get used up, that the price of carbon will go up. There's just this year, 2021, there was a new futures market in some of these carbon offsets, some based on forestry, some on other areas. But it's really new market, and there are no exchange-traded funds that are investing in these carbon offsets yet. So we're going to keep an eye out for them. So all the action at this point in the carbon market is really these carbon futures in the cap and trade emissions trading system. Now, on the Money for the Rest of Us website, there's an investment guide on what you need to know about carbon investing. And I'll go in, you can take a look at the table of contents. There's also a podcast on the topic that I go into a great deal of detail. But that's our discussion of carbon investing. It's a new market, but it's a very, very important market because it will require a reduction in greenhouse gas emissions in order to reduce climate change and some of those catastrophic impacts. So, hey, if you like the video or you have questions, leave them below. Give the video a thumbs up. Please subscribe to my channel. And we'll see you next time we release a video. Thanks.